Your checking account says $1,800, so you make a $200 purchase, but $1,650 is already committed to bills before the next paycheck. The amount that was actually uncommitted was $150. That purchase creates a $50 shortfall. The problem was not that you could not see the balance. The problem was that one number was doing 5 jobs. This is why one checking account can feel like it is costing you money. It is not a fee for having one account. It is the ambiguity. Bill money looks spendable, savings looks optional, and automatic payments arrive on their own schedule. We are going to give 5 jobs their own lanes: bills, flexible spending, emergencies, planned goals, and long-term investing. Then we will make the system smaller if 5 real accounts would create more fees or friction than clarity. Imagine an overstuffed drawer. Rent, groceries, a car repair, a vacation, and retirement are all inside. The drawer can tell you how much is there. It cannot tell you what the money has promised to do. Cash flow is partly about timing. The Consumer Financial Protection Bureau notes that when the timing of money coming in and going out is off, a person can run short at the end of a week or month. Automatic payments can help bills arrive on time. But if the balance is too low when a payment runs, the bank and the payee may charge applicable overdraft, non-sufficient funds, or returned payment fees. The goal of these buckets is not to make the numbers bigger. It is to stop one balance from pretending that committed money is available. 5 jobs does not require 5 bank accounts. You can use separate accounts, sub-accounts, or savings buckets offered by one institution, or a written ledger. We are designing the labels first, the plumbing comes second. The first bucket is the income hub and fixed bill account. Pay arrives here, and predictable obligations leave from here: housing, insurance, subscriptions, minimum debt payments, child care, and a realistic allowance for bills that vary. Do not use this debit card for ordinary shopping. The visible balance includes money already assigned to future dates. Build a bill calendar with amount, due date, and whether the bill pulls automatically or must be pushed manually. Then keep a small timing cushion based on your own bill volatility and account rules. That cushion is not a universal dollar amount. Direct deposited funds do not have to be available the instant they appear pending. Federal guidance says a bank or credit union must make the funds available by the next business day after the business day it receives the deposit, although many institutions make electronic payroll deposits available immediately. Check your actual policy. This bucket answers one question. After accounting for scheduled obligations, is the bill system funded? The second bucket is for flexible spending. Groceries, restaurants, entertainment, small household purchases, and other choices that can change this week. This is the account whose balance can function as a spending boundary. If the bucket has $400 until the next paycheck, you do not have to mentally subtract rent every time you buy groceries. Rent is somewhere else. That does not make the spending amount correct for every household. It makes the trade-off visible. There is also an operational benefit. A surprise purchase in this lane does not directly change the amount sitting in the bill lane, but separation does not guarantee safety. A linked overdraft service, a recurring payment attached to the wrong account, or a transfer that has not settled can still cross the lines. Review which account every merchant is authorized to debit. Monitor the amount and timing of automatic payments. The third bucket is emergency savings. The CFPB defines an emergency fund as cash reserved for unplanned expenses or financial emergencies, such as repairs, medical bills, or loss of income. There is no single correct target for everyone. The amount depends on the situation. The fourth bucket is for planned irregular costs, often called sinking funds: an annual insurance premium, holiday travel, tires, school supplies, or a known move. Both buckets hold money for later. The difference is whether the event is unplanned. If tires are expected this year, paying for them is not an emergency. A separate goal label keeps a predictable expense from repeatedly emptying the emergency reserve. Many institutions allow recurring transfers from checking to savings. Some employers also allow a paycheck to be split across accounts, but those features and their terms vary, so confirm transfer dates, minimum transfer amounts, and fees before relying on them. Automation should follow a plan. It cannot replace a balance check. The fifth destination is long-term investing. This might be an eligible workplace plan, an individual retirement account, or another investment account chosen after considering the viewer's own circumstances. It is not just another savings jar. Securities and mutual funds are not federally insured like FDIC-insured bank deposits, and investing can lose principal. That remains true even when an investment is purchased through a bank. So the visual line between bucket 4 and bucket 5 matters. Near-term money has a near-term job. Long-term investments accept market risk for a different horizon. This episode does not choose an investment, account type, contribution amount, or order for you. It simply reserves a lane, so invest later does not compete with every purchase in the checking account. And if investing already happens through payroll before take-home pay reaches you, record that lane in the map rather than transferring the same dollars again. Now let us route a completely hypothetical monthly take-home amount of $4,000 paid as two equal $2,000 paychecks. This is not a prescribed budget. For the month, assign $2,300 to the income hub and fixed bills. Assign $800 to flexible spending. Route $400 to emergency savings, $300 to short-term goals, and $200 to the long-term investing destination. $2,300 plus $800 plus $400 plus $300 plus $200 equals $4,000. For each $2,000 paycheck, that becomes $1,150 for bills, $400 for flexible spending, $200 for emergencies, $150 for goals, and $100 for investing. $1,150 plus $400 plus $200 plus $150 plus $100 equals $2,000. The percentages are not the lesson. Your income, obligations, fees, access, and priorities change the amounts. The lesson is that every dollar receives a job before the flexible spending balance invites a decision. If income is irregular, route by percentage or priority when money arrives, then maintain a larger timing margin appropriate to your situation. Do not copy these numbers. Now the important part, 5 accounts can be worse than 1. Banks and credit unions may charge monthly maintenance fees. Some waive them only when you maintain a specified balance or use direct deposit. Account disclosures must describe fees, minimum balance rules, and transaction limitations. If opening 5 accounts creates 5 minimums, 5 fees, or 5 opportunities to miss a rule, compress the system. Use 1 checking account, 1 savings account with internal labels, and 1 investment destination. Keep the 5 jobs in the ledger. Second, do not assume overdraft settings are a force field. A bank generally needs your affirmative opt-in before charging a fee for paying ATM or one-time debit card overdrafts. That protection does not cover every check or ACH situation, and the institution does not have to pay an overdraft even after an opt-in. Third, 5 tabs do not mean 5 insurance limits. At an FDIC-insured bank, the standard limit is $250,000 per depositor per insured bank for each ownership category. Same category accounts at the same bank are combined. At a federally insured credit union, a person's single ownership accounts at that credit union are also added together and insured up to $250,000. Account count is not ownership category. Finally, schedule transfers before the money is needed. Verify that funds are available and use low balance alerts. A diagram cannot overrule your institution's terms. Start with a map, not 5 applications. List every inflow, every bill, every automatic debit, and every savings or investing transfer. Label each one with a job and a date. Next, inspect the account disclosures for monthly fees, minimum balances, transfer fees, transaction limits, and conditions for fee waivers. Then choose the smallest implementation that keeps the 5 jobs legible. It might be 5 accounts. It might be 3. It might be 2 accounts plus a careful ledger. Route a small amount and run the system for 1 full pay cycle before moving every automatic payment. Confirm which transfers completed, which balances were actually available, and whether any bill pulled from the wrong lane. The title is not saying one checking account is always costly. One account becomes costly when its balance hides commitments and invites the same dollar to do 2 jobs. Separate the jobs. Automate only what you can verify. Compress the accounts when fees or timing make the structure fragile. If you want a practical next step, pause this video and write 5 labels: bills, spending, emergency, goals, investing. Put each current transaction under 1 label. Do not open anything yet. That map is the real system. This is general financial education, not personal financial, investment, legal, or tax advice.